There are two big picture approaches to making money or creating value in commercial real estate: developing properties and working on existing properties. And today, we're gonna dive into both. I'm Joshua Pardue, and I help investors live the life of their dreams by teaching them the skills, strategies, and mindsets to build a multi-million-dollar portfolio. First, let's lay the groundwork. We're gonna talk about strategies to create value and capture value, but we also have to talk about the asset classes within those strategies. The big asset classes are office and healthcare, industrial and storage, multifamily and senior living, and then retail and entertainment properties. Commercial real estate is simply making money on real estate. That's either having your business in a property that you own and occupy, or building or owning a property and leasing it to someone else for the income as an investor. There's a lot of material on residential real estate, which is really 4 or less of dwelling units for individuals to be occupied as their home. When we're talking about multifamily today, we're purely talking about 400 to 300, 500 units for the purpose of generating income producing properties. So how do you make money in commercial real estate investing? Now let's talk about where you actually get your returns. You either get your returns from appreciation or you get your returns from annual reoccurring cash flow. Now, with both of those strategies, you're gonna eventually sell, and hopefully you're exiting for a lot more than the sum of your acquisition plus your additional renovation investments and carry cost along the way. However, it's an important distinction. Am I buying an income property, or am I taking a non-performing asset like a vacant building or vacant land and converting it into an income producing asset by getting it leased up, repairing it, doing all the strategy required? So ultimately, when you exit from a non-performing asset to a performing asset, you're selling an income property to someone else that will pay top dollar in order for that income stream. That's being a developer. This ties into another important framework that we've discussed. 3 types of investing strategies: opportunistic, high risk, high return; value add, or medium risk, medium return; and stable income or core investment, which is low risk, low return. You're really just talking about income properties. Think about how you pair one of those 3 investing strategies with these 2 different approaches that we're diving into today of developing properties or working on existing properties. Now that we've gone over the basics, asset classes, returns, the 3 investing strategies, let's now jump into the 2 ways that you make money in commercial real estate: developing and working on existing assets. Real estate development is a prime example of opportunistic investing. It ranges from horizontal land development, redevelopment of existing properties, or traditional vertical development and construction. The goal at the end of the day is to provide a product and property for a future user so the investor can receive the benefit of the income of that property. Development is simply the process of working on a property to make it more functional for a user and to create ongoing returns for the developer and investor involved. The process goes into land acquisition or building acquisition. Then you move into the planning and approvals phase, which is typically working closely with your civil engineer and your architect to design the actual building and structure. You're gonna work in close conjunction with your municipality at that point to make sure you have your zoning, your land use, all of your different approvals required, all the things you have to determine before you acquire the property to make sure it's a safe investment. A few real life examples are a land development project. For example, we're working on one of those where we're purely just building lots and we're gonna sell those to a national home builder that's gonna come in and build the house. That's all horizontal: roads, underground infrastructure, getting the pools, things like that in, but not going vertical. Another example is an adaptive reuse of an existing building, which we have an abandoned public building from the early 1900s, in which we're taking that and converting that existing structure from a community center into apartment building, all the units filling up the big open space. The final concept is true ground up, which we're doing all over the country, which is when you buy a piece of land, but you go into it with a plan in order to build a structure that once it's complete will be fully occupied and income producing. Those are 3 core examples of how to develop. Look, development's not for everyone, and it requires a unique skill set and a lot of different experiences. The second approach to making money in commercial real estate is working on existing properties. And an easy way to break that down is vacant, partially occupied, or fully leased buildings. Vacant buildings. When you're buying a vacant building, all you're really doing is converting a non-performing asset to a performing asset. Simply stated, You're buying a building based on a price per square foot vacant. It's typically a little lower. And you're adding dollars, you're investing to carry it with time, you're designing, you're marketing, you're leasing it up, and it trades based on the income divided by a cap rate to get the new value, and your price per foot is a lot higher than when you acquired it at the vacant price per square foot. Buying a vacant property and converting it to an income property is still higher risk, higher return. That's still opportunistic. Now we're gonna move on to buying properties with some existing income in place and move to more of a value add strategy, medium risk, medium return. Partially occupied building investments is still a medium risk, medium return value add strategy because they typically already have some income in. You're acquiring off of the per square foot metric, but you also have some income. But your goal is to use your expertise, liquidity, relationships, and vision to add more income by either driving up the rental rate with a better project or leasing the rest of it out. That adds to your net operating income that when you go to capitalize that and exit, you have a nice gain on the end. Lastly, we have fully occupied existing buildings. They're typically characterized as low risk, low return. This is also referred to as core investing. These are fully occupied, stable, quality assets, often located downtown, credit tenants, long-term leases. These investors are looking for stable and consistent annual cash flows. That investor does not want to be involved in the day-to-day. They do not want hand-holding. They want long-term annual reoccurring cash flows. Lower return, lower risk, not a big exit, but they're not actively involved. That's a great strategy for an institutional investor or a retiree that just wants to put some money to work. So now you know the basic concepts and the two key approaches to making money in commercial real estate: developing and working on existing properties. If every day you can come in and focus on your projects and just do those simple activities, add income, add value, and exit, you'll create a lot of value in your commercial real estate career.